While it might seem like just another task that you need to get done in the early days, it quickly becomes one of your most scrutinized documents. Your future self and your investors will thank you. This week, I'm in Switzerland for Hack Summit, which is a climate conference. As you may know, I'm an investor in seed stage climate tech startups, so I'm excited to meet founders and investors and see how we might collaborate. With that in mind, today I thought we would go over some startup financing basics, a term you'll often hear whether you are a founder, VC, or angel investor is cap table. In fact, even as a tech employee, you'll want to know what a cap table is so you know how your options are determined and what they'll be worth if your company exits or goes public, which is the goal. Essentially, we're asking who owns what. As your company grows, you'll start issuing all different kinds of equity ownership, either shares or rights to ownership. This goes to people involved in the business like employees, investors, and startup advisors like me. The shares given out have different types of rules. While some founders may start casually with a spreadsheet, which is probably normal when you're just two people in a kitchen, there is some really great software out there which you'll want to consider as you scale, and a really common one is Carta. So, what is a cap table? A cap table or capitalization table is a critical document that tracks ownership in your startup. It should be created when you legally incorporate your company, and it serves as that single source of truth for equity ownership. So when do you create your cap table? Well, as I mentioned, when you incorporate, you'll declare how many shares you're going to create. According to Carta, this is typically around 10 million. Initially, these shares are usually split between co-founders. Common splits could be 50-50 or 55-45 or other arrangements based on the contribution of each founder. So what does the cap table track? We're gonna go into this, but let me give you a quick overview. Ownership percentages of all shareholders, values of shares and their classes, think common or preferred, vesting schedules for founders and employees, option pool for future employees, investment rounds and dilution history, how and when people can receive shares and how they pay for them. So as I mentioned, to create your cap table, you can create it yourself or you can hire a lawyer. However, keep in mind that as your company grows, you'll need to graduate from spreadsheets to more robust solutions that can handle complex scenarios, like options, like option grants, conversions, and financing rounds. A DIY spreadsheet solution is no longer going to cut it. Let's talk about ownership rights. There are different types of shares, and a share price is determined at the time that the share is granted. So we'll take a look at common shares and preferred shares. Common shares are typically split among the co-founders. You can think of this as the vanilla equity option, whereas preferred shares are different. Preferred shares come with special privileges for investors. This gives them first dibs whether you gloriously IPO or get acquired. It also means that investors are first in line to be paid out if the company goes bankrupt or liquidates assets. There are some other key terms that I want you to be aware of here, so we'll dive deeper into stock options, but just to briefly kind of touch on this, stock options give employees the right to buy stocks at a fixed price. This price is predetermined, sort of like a rain check for equity. The other thing you should be aware of is participating shares. This is when preferred shareholders get to sort of double dip, and they could get 2x or 3x in extra returns, in addition to being first in line for payouts. And this is before common shareholders even see a penny. I've actually been in, well, not me personally, but I've observed a situation where a startup did liquidate assets. And of course, everything goes to the investors first, meaning that at the end of the day, the founders are really not left with much. Last thing to be aware of is the term sheet. This is sort of like the investor's prenup. This outlines share preferences and rights, so make sure that as a founder you read the fine print. Okay, let's dive into convertible instruments, which is perhaps lesser known. Convertible instruments are for raising money when you don't know how much a share is worth yet. This is perfect for early stage financing and makes negotiations much quicker. Here we're taking a look at two different convertible instruments. We have convertible notes and safes. Convertible notes are like an IOU, but they come with benefits. So this is money plus interest, which converts into equity upon a trigger event. This could be a funding round or a specific maturity date. This comes with a discount and can come with a valuation cap. Safes are a simple agreement for future equity. This is not debt, it's just a promise. You'll convert their investment at the next round with no interest or maturity date. This may include the most favored nation status, which means if another investor comes along later and gets better terms, the first investor is going to expect these terms as well. So the first investor with that most favored nation status. I want to underscore here that convertibles are not free money. Whether or not you raised a price funding round, you must pay back the investor. When the maturity date hits, be prepared to either convert to equity, negotiate an extension, or face potential legal action. So to be clear, if you can't convert into equity on the given date, the investor could agree to a later date, or they could potentially sue you. So you'll want to be careful here. And then a quick note here on dilution that founders and investors should be aware of. Dilution is a reduction in ownership percentage for any individual investor caused by more investors entering the cap table. So to think about this in simple terms, if you're at a birthday party and there's a cake, if there's only 3 of you, you get to split that cake and have massive pieces. However, the more people join the party, the smaller your pieces get because you need to share with everyone at the table. Make sense? Even convertible instruments represent this future dilution because in a convertible, they've essentially called dibs on those pieces of your company. Company, cake, same thing, right? So the cap table doesn't lie. The more investors, the smaller your founder piece. Let's talk a little bit about organizing the cap table. So we've spoken now about equity types. Different types of equity come with different rules. You have your actual shares and you have your convertible instruments, which again allows for shares at a later date. I've said that I think 3 times now, so hopefully you remember it. Stock options are also not shares. Stock options enable employees to buy at a later date. However, for employees, their price is locked in. Your cap table also details vesting. So if we go into vesting 101, vesting exists to incentivize employees to 1, stick around, and 2, be personally invested in the success of the company and thus perform well. So again, your cap table tracks the vesting schedule. This could be time-based vesting, which is the only thing I've seen, but there's also milestone-based vesting. So time-based vesting is the most common, typically over a 4-year period. For the first year, you unlock 25%, and then either monthly after or quarterly, over a 4-year period, you unlock 100%. Milestone-based vesting, on the other hand, is based on accomplishing a specific goal. So when you exercise options, you're buying shares at the promised strike price, which is another term that you'll probably hear. For example, $1 a share, let's say. And this is regardless of the current value, because remember, your price was fixed. So once you're fully vested, you have access to 100% of your stock options or your promised equity. It's good to note that buying is optional. So what happens when employees don't buy their shares? Because I'm sure we've all been at startups where we decided not to buy. So when employees don't buy shares, they expire and they get put back into the option pool. I do want to briefly mention public companies here because that is different. Public company employees receive RSUs or restricted stock units. This is stock-based compensation issued by the employer. For example, at Zendesk, I got 25% after 1 year, and then every month after I got paid out. If I had stayed over the full 4-year period, I would have received 100%. Now let's talk about some things that are good to keep in mind for founders. The things that I'm going to mention here are specific to the US market. However, no matter where you are in the world, it's good to check your local regulations for similar requirements because there's probably some sort of equivalent. So the first thing I want to mention is Rule 701. Now, if you're in the US and you go over 10 million in equity compensation in a 12-month period, then the SEC is going to require you to do a 701 disclosure. This is expensive and requires legal help, which is also expensive. So do your best to avoid this by keeping track of your cap table. Now let's talk about fair market value and 409A. So a 409A determines your common stock price through an independent valuation. There are 3 key methods here used in this approach. So the first thing is going to be the market approach. This is based on investor pricing of shares in a recent round. 2 is going to be the income approach. This is based on revenue, cash flow, and expected future cash flow. And third, we have the asset approach. This is based on net asset valuation. For example, it could be equipment, for pre-revenue and pre-funding companies. So basically, they don't have too much to go off of. So these valuations aren't just paperwork. They set option prices, and they help avoid tax headaches for everyone. Your cap table is your story. Who owns what, who's owed what, and even your timeline, and how value will be distributed in both success and failure cases. And it's good to just be prepared for whatever outcome. While it might seem like just another task that you need to get done in the early days, it quickly becomes one of your most scrutinized documents during fundraising, acquisitions, and strategic decisions. So invest in the time to get it right, update it regularly, and understand the implications. Your future self and your investors will thank you. So what are the essential bytes here? And if you don't know, for the newsletter that I write that goes out every Wednesday, which is free and available to everyone, I always end my newsletters with the essential bytes, which is just the key takeaways from that article. So if you're interested in that, it will be linked in my bio or in the description. Start early and stay organized. Create your cap table at incorporation and graduate from spreadsheets to specialized software as you grow to properly track ownership, valuations, and vesting schedules. Next, understand your equity types. Different instruments come with different rules, rights, and consequences. Know what you're offering and receiving. Mind the dilution. Each new investor or equity grant reduces everyone's percentage ownership. Plan your option pools and funding rounds accordingly. Consider maintaining appropriate founder and employee stakes. And last but not least, stay compliant. I've mentioned the 409A valuations to set your fair market value. And I've mentioned monitoring the Rule 701 threshold. And this is specific to the US market, as I mentioned, but I'm sure there are similar regulations in your own country. So that was a lot of information. Thank you for sticking with me through it. Feel ready to raise money for your next step or have a negotiation on your stock options. Comment your thoughts below, and I would love to see if you have recommendations for other people on how to handle your cap table or your stock options. Thanks for listening. Don't forget to subscribe to the channel. Feel free to drop a comment and request a video, and make sure that you subscribe to my newsletter in order to get the Monday podcast highlights, resources, and the Wednesday essentials.